Bank account freezes, how modern banking policy silently restricts financial access. 1. Sudden freezes and algorithmic errors. Banks across the United States are increasingly freezing consumer accounts without prior notice. Users report being locked out of funds during routine transactions such as purchasing groceries or transferring small amounts. These freezes are often attributed to fraud detection, anti-money laundering protocols, or errors in artificial intelligence-driven risk engines. Financial institutions have quietly automated the freeze process, which frequently flags legitimate user activity as suspicious. The severity of this issue is compounded by the fact that consumers typically receive no forewarning. An account labeled as under review can remain inaccessible for up to 14 days, severely disrupting small businesses and individuals who rely on daily liquidity. Consumers are left with little recourse in the moment, as the institutions typically invoke internal security protocols as justification. Footnote: Financial institutions increasingly rely on AI and algorithms that mistakenly flag routine activity, leading to account freezes without notice. 2. Guilt by digital association. An emerging cause of account freezes stems from negative media mentions, legal disputes, or shared names with flagged individuals. These digital associations are often processed through third-party databases and applied automatically, irrespective of actual wrongdoing. In some cases, transactions linked to individuals flagged by internal systems have caused innocent users to lose access to their accounts. Furthermore, banks can legally restrict or terminate accounts without any obligation to notify customers beforehand. Consumers experiencing such freezes report significant difficulty regaining access, particularly when institutions cite vague policies such as internal review or risk strategy. Footnote: Account restrictions can result from inaccurate data associations or unrelated third-party issues, not consumer misconduct. 3. Institutional risk strategies and account purges. Modern banking increasingly prioritizes risk-weighted profitability. This has led to an unspoken purge strategy. Accounts with low balances but high activity may be deemed unprofitable and thus more susceptible to closure or restriction. Financial institutions are not legally required to maintain client relationships they deem risky or economically inefficient. In 2023, major banks conducted mass account closures citing vague internal audits. Importantly, FDIC insurance does not protect consumers in cases of frozen accounts, only in the event of total institutional failure. Consumers mistakenly believe they are protected, only to discover that freezes fall outside the coverage scope. Footnote: Banks may freeze or close accounts under internal risk frameworks with no legal duty to provide prior warning. 4. Defensive consumer measures. Consumers are advised to diversify financial holdings across multiple institutions. Relying on a single bank for all financial needs increases exposure to freeze-related disruptions. Secondary accounts, emergency cash reserves, and digital wallets such as PayPal, Cash App, or Venmo serve as fallback options. Credit cards also serve a critical buffer in emergency situations. Used responsibly, they provide temporary access to capital while account issues are resolved. When a freeze occurs, the consumer should immediately contact the institution's fraud department, request specific reasons for the restriction, and promptly submit requested documentation. If resolution is delayed, consumers may escalate complaints to the Consumer Financial Protection Bureau, CFPB, for faster resolution. Footnote: Proactive account diversification and digital wallets reduce risk exposure. Credit cards and CFPB complaints assist during freezes.